Joining us right now to talk about what's going on these markets, which have been on a bit of a roller coaster. Emily Roland, co-chief investment strategist at Manulife. John, Hancock Investments. We got a whole bunch of earnings coming up this week. We've had this sort of seesaw situation since Friday when it comes to the markets with the tariff component. What should we actually be paying attention to?
Yeah, it certainly feels like Christmas morning that we're getting these earnings results, especially given the lack of data and the political developments we've seen over the last couple of sessions. We're hoping for a nice rerun of the last couple of quarters where analysts pencil in high single-digit estimates and companies beat with low double-digit results. I think the plot twist, though, this time would be, can companies start to quantify the impact of tariffs on their results? In the second quarter, CEOs talked about the potential for the punch from tariffs to impact their businesses. Now that that punch has been delivered, can companies quantify that? We've seen negative earnings revisions in areas like consumer staples and materials. We may start to see the margins of those businesses impacted by tariffs this quarter.
In terms of the banks,
yeah,
we're obviously getting those numbers. Of all of the companies that you want to see this quarter to try to better understand what's really happening, you want to see what?
So financials is so critical, Andrew. When you think about the fact that the stock market has been the biggest driver of the U.S. economy, financials are in the front seat of that. So we're looking in particular like areas like wealth management and capital markets, as investing in financial outcomes or financial assets have really produced superior outcomes. We're watching for potentially more guidance on M&A from mid-sized banks that are expected to see 30+% earnings results this quarter. The yield curve is steeper than it was a year ago, another potential tailwind. So the fact that the market is up as much as it is over the past year, we think is going to be a significant tailwind for the financial sector. Tech is another one, of course, the other area with the biggest positive earnings revisions, 5% up to about 20% earnings expected in the third quarter. We'll be watching that. There's almost a symbiotic relationship between tech and financials here, is because tech has driven the market higher. That's helping these wealth management businesses as well.
Of the banks, is there one or two that you like more than another?
We don't do individual stocks, so we're watching the sector here more broadly. I do think regional banks have the most sensitivity to this. So looking down in market cap, mid-cap banks have been an area that we have favored, given some of the potential M&A that we see coming down the pipeline and some more exposure there to the U.S. economy.
And finally, how do you think about some of the smaller companies on the Russell, for example? Do you think that they're out of favor, going to be in favor?
So we have been underweight small caps. Almost 40% of the Russell 2000 index is comprised of unprofitable companies. We are focused right now on companies that make money. We're drafting off the equity market in our views right now with an overweight to higher quality companies. We're fully invested, but we're not chasing junk here. We do think if there's some more volatility here, you could feel it in the smaller parts of the market. Mid caps, again, have been the sweet spot to manage the valuation risk, the concentration risk that's inherent in U.S. large cap stocks, but really staying away from some of the more speculative corners of the market here as we head into the last couple of months here of the year.